Hello and welcome to the latest episode of Legal Bites, the official podcast of Cummings and Cummings Law, where we focus on helping businesses and their principals re-domesticate out of volatile legal and tax environments like Virginia to more predictable pro-entrepreneurship, pro-growth jurisdictions. Today, we are discussing how to move your existing LLC or corporation out of Virginia to a new state to avail yourself of tax benefits, among other advantages. But first, a brief introduction. My name is Chad Cummings, and I am an attorney and a certified public accountant serving clients in matters of business, tax, and commercial law. I am Chief Executive Officer of the multi-state, multi-attorney law firm Cummings and Cummings Law. And in addition to my day job, I also teach business and tax law at the university level. I hold 4 degrees, including 2 law degrees, as well as a bachelor's degree in accounting and a master's degree in taxation, in addition to 11 professional licenses and certifications covering accounting, tax, audit, and of course, the law. My firm website is www.cummings.law. Now on to business. Virginia ranks in position number 30 on the Tax Foundation's most recent State Tax Competitiveness Index. It's not the best, it's not the worst. It is in what I call the mediocre middle. That is to say, the state level tax code is moderate. The corporate income tax rate is a flat 6%, close to the national average, which sounds great until you remember some states don't have corporate income tax. Virginia does not impose a so-called throwback rule, a statewide gross receipts tax, or a capital stock tax, and this is good, it conforms to federal net operating loss treatment. That is a good thing. It does not impose a state level estate or inheritance tax yet. The public pension system is fairly well funded at 91%. On these metrics, Virginia, as I said at the beginning, I did not bury the lead, Virginia is not the worst place to be. The problem, however, is not the state code. The problem is the local code. And in Virginia, the local code is where the damage accretes. Virginia's individual income tax has a top marginal rate of 5.75%. That rate kicks in at only $17,001 of taxable income. That is one of the lowest top bracket thresholds in the United States. A business owner earning only $50,000 is in the top bracket. They are in the same bracket as a business owner earning $100 million, at least in the state of Virginia at the individual level. The graduated structure is a fiction. For any taxpayer earning above that $17,001 threshold, Virginia functions as a 5.75% flat tax at the state level without at least the honesty of calling it a flat tax. The effective rate on pass-through income is therefore 5.75% for every business owner who earns more than what it essentially amounts to a part-time salary. The Tax Foundation identifies Virginia's most significant competitive weakness as a trio of local business taxes that counties and independent cities are entitled to impose. That is a bad thing. Each locality can choose 2 of 3 taxes. Boy, this sounds complicated because it is complicated. A tax on business personal property, a tax on business inventory, and a gross receipts tax known as the BPOL or BPOL tax. The BPOL tax, the Business Professional and Occupational License Tax, is a local gross receipts tax assessed against revenue, not profit. A business generating $2 million in revenue and losing money at the bottom line will still pay the BPOL tax. The tax applies to the gross figure regardless of expenses, cost of goods sold, or compensation. It is a tax on revenue that operates at the local level in a state that does not impose one at the state level. But at the end of the day, it doesn't matter. You're still being taxed if you are in Virginia. The business personal property tax applies to tangible personal property, including equipment, furniture, fixtures, and in some localities, vehicles. Ouch. Virginia provides no de minimis exemption for this aggressive tax. Every business that owns physical assets must file and pay every year, regardless of the value of those assets. A business with $5,000 in furniture bears the same filing obligation as a business with $5 million in equipment. The compliance cost is the same, although the tax bill will be different. The business inventory tax applies to goods held for sale. Most states have eliminated inventory taxes because they penalize businesses, particularly small and medium-sized businesses, for holding stock. Virginia has not. They are lagging behind. The combination of any two of these three taxes creates a local tax burden that varies by jurisdiction and is layered on top and not in place of the state income tax. A business owner, for example, in Fairfax County faces a different tax regime than a business owner in Richmond or Virginia Beach. The fragmentation creates headaches, compliance costs, planning difficulties, and effective rate differentials that are invisible in apples to apples state level comparisons. Virginia does not permit businesses to claim bonus depreciation or full expensing at the state level. That is a major negative. A business that deducts the full cost of a capital investment at the federal level must then add back a portion of that deduction when calculating Virginia taxable income, all for the privilege of transacting business in the Commonwealth. This nonconformity increases the effective corporate tax rate on capital investment and penalizes businesses, particularly startups, that invest in equipment, technology, or physical infrastructure. State and local tax collections per capita are $6,845, while state and local debt per capita is relatively high at $9,236. Virginia's economy is concentrated in the federal government, as you know, and government adjacent sectors, particularly in Northern Virginia. Federal workforce reductions, which the Pew Charitable Trusts identified as a risk factor for state budgets, continue to be a direct threat to Virginia's revenue base. Cuts to the federal workforce reduce incomes in the state, reduce consumer spending, and reduce the income tax collections that fund nearly 1/3 of the state's revenue. To put all of this in perspective and to use some nice round numbers for an example, on $500,000 of annual pass-through income, 5.75% produces almost not 13, but $30,000 in annual state income tax. Add the BPAL tax on gross revenue and the business personal property tax on physical assets, and the total burden exceeds the income tax alone. Remember, you have options. In Florida, that number would be zero. In Texas, the income tax figure would also be zero at the state level for individuals. In fact, Texas has a constitutional amendment to that effect. These states, Florida and Texas, among others, impose no state-level individual income taxes, and most small and medium-sized businesses in these two states impose no business-level income taxes either. All of this to say, why would you remain behind in Virginia unless you have family or kids or some other compelling reason, which I understand? But on paper, looking at the numbers, why would you choose to domicile there if you have a choice? That is a rhetorical question. With that in mind, redomestication. Let me say the word again because it is a mouthful. Redomestication is the lesser known legal process of transferring a company's legal state of domicile to a new state without dissolving it. Excuse me, let me clear my throat. Without dissolving it, there we go. Without creating a new entity, that's important, and without triggering a federal income tax, but only when performed within the strict formalities required under the Federal Internal Revenue Code, applicable Treasury regulations, and the statutory frameworks of both the destination and departing states. And before we get any further, let me be absolutely clear. Yes, Virginia absolutely permits redomestication. If somebody is telling you otherwise, they don't have a clue what they are talking about. I know for a fact because we have handled a large number of redomestications out of Virginia at my law firm, all with a 100% success rate to date. When executed by a competent professional, the company retains its existing federal employer identification number, contracts, credit history, and bank accounts. There is no operational or financial disruption. Now, let us dispel some misconceptions. Foreign entity registration, also referred to as foreign qualification, depending on the specific terminology used in the destination jurisdiction, does not change the company's domicile. Foreign entity registration is not the same thing as redomestication because it keeps the entity in the Commonwealth of Virginia and merely adds a second layer of tax and compliance obligations in the new state. Meanwhile, a traditional merger is also not the same thing as redomestication because a traditional merger creates a new distinct entity in the destination state and can trigger serious and sometimes irreversible tax consequences. Finally, dissolution should not enter the conversation at all. Dissolution terminates the company. It is the legal equivalent of the death penalty for the enterprise. Unless the business is truly shutting its doors and going out of business, dissolution should not be on the table. As I said, dissolution is a going out of business measure, not a relocation measure. And if you have a so-called professional telling you otherwise, please seek better counsel. Redomestication, when paired with a change of personal residency and this is an important a reduction or outright cessation of business operations in the Commonwealth can reduce or even eliminate state tax exposure for the entity and its owners. Virginia's state tax code is mediocre. The BPAL tax is a gross receipts tax on revenue. The personal property tax has no de minimis exemption, and the top income tax bracket starts at only $17,001. And the federal workforce that funds the economy is shrinking. You do the math. There are better options out there. Now is the time to consider acting before the Virginia legislature changes the law to hinder or even eliminate the option of redomestication. If you have questions regarding potentially redomesticating your existing limited liability company or corporation out of Virginia, please use the link in the description for more information on this nuanced process and to schedule time for you and I to speak one-on-one about your specific scenario. Again, my name is Chad Cummings, and I hope that you found this information informative. As always, the information in this presentation is necessarily general in nature and is not legal or tax advice because that advice definitionally must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my earlier presentations, please visit my firm website at www.cummings.law, not .com, but .law, to schedule time for a consultation. I look forward to that opportunity to speak with and perhaps even work with you very soon.